Okay, in today's class, we are going to discuss what a stock market or a stock exchange is. Okay, so the topic is the stock exchange, and we'll be using a few examples to illustrate and explain what a stock exchange really is. So, even though I'll be using the example of various markets, most notably the market for cars, to explain what a stock exchange is, because there are some analogies between these two markets. So I'm going to discuss that. First, I'll discuss the market, then the market for cars, and then what a stock exchange is. But throughout this lecture, please keep your focus on the stock exchange. All right. Even though I'm discussing a couple of markets, I'm not discussing the market for cars or the market for television. I am ultimately trying to get to the point where I explain to you um, in detail and in a way that you can understand what a stock exchange really is. So, what is a stock exchange, or as it is called, a stock market? So, in order to understand, first let us go back. Let's take a step back and try and understand what a market is. Okay, so what is a market? Uh, Usually, when I ask this question, all right, what's a market? I get the answer, sir, a market is a place where we buy things. Okay, so there are a couple of problems with this definition. Firstly, all right, look, when you look at a market, what comes to your mind? Okay, uh, if your mother says to you, go get some eggs from the market, so you are looking at the market from your angle. At that point, what are you? You are a consumer. You are going to buy eggs. You're going to buy eggs for your own consumption. So you become a consumer. What does a consumer do? What makes a consumer a consumer? So a consumer creates demand. Okay, so that's the first concept that you have to start warming up to. Demand. What is demand? I want something. Does that automatically mean I'm demanding it? No. Unless and until I have the ability to pay for it, I cannot create demand. I may want eggs, but if I don't have the power to purchase them, another word, purchasing power, if I don't have the power to purchase them, then I will not be able to create demand, right? So, and it works the other way too. If I have the purchasing power, but I don't want something, even then I will not create demand for that particular product. It can be so frustrating to a salesperson when he wants to sell something to a person who has money, but that person just does not want that something. He's not creating demand for that product. So what is demand? Demand is the willingness backed by the ability to pay for a product. Okay, so when a consumer is going to the market, he is looking at the market and he is seeing shops, he's seeing vendors. These vendors are able to fulfill his needs. So in other words, whatever he demands, the sellers are able to supply them. Okay, so in a market there are two forces. In a market there are two things: demand and supply. Okay, so so now refine your definition. Market has demand and supply. Okay, second thing, let's look at the definition of the student again. Market is a place where we buy things. Okay, no, so we don't buy things. In the market there are the forces of supply and demand. Market is a place. Is market really a place? Yeah, there was a time when there used to be designated spaces where people would set up shop and they would sell the goods. But does that happen now? No, that does not happen now. Look at the market for foreign exchange. Look at the market for currency. The exchange of currency has always happened over telephone lines. Okay, when you go to exchange, a currency exchange, I'm not talking about a stock exchange, that's the market for currency. So you say, I want to buy so many dollars. So what will the person do? He's going to pick up the phone and he's going to find out where in the market the dollars are sitting, and then he is going to order the dollars, and the dollars will come and you will buy the dollars, right? So what is that market? That market is basically the telephone connection of all the people who are buying and selling currency. I mean, this used to happen about 20, 25 years ago. Today, they have shifted everything to digital technology, to online trading. Okay, you go to Alibaba.com or you go to Amazon.com. You purchase a certain good. You have not gone to a place. There is no place. Okay, the place is your cyberspace. So then how do you refine the definition of a market? The market is not a place. The market is a mechanism by which demand and supply interact to fulfill the needs and wants of people at a profit for the supplier. That's important. People will only give money if the product fulfills their needs and wants. And if something fulfills your needs or wants, it is said to have value. It has value for the consumer because it is fulfilling a set of needs and wants. And that's why the consumer is willing to part with his hard-earned money, because that product is fulfilling his need and want. But that's not enough. The product should not just fulfill the need or want of the customer. It should also give a profit to the producer. Otherwise, he will stop producing the product. So let's come to, now that we've understood the market, let's have a look at what types of markets there are. Okay. So for this discussion, we are going to look at two types of markets. Okay. Markets, the categorization of markets is in various ways, but we're going to look at two types of markets. Now, this is where we will take the example of the market for cars. Let's say that in 2020, remember the time 2020? We were just coming out of the COVID-19 lockdown, and people are coming out and they say, I want a new car. Let's say I want a new car. I want to have a nice time. I want a new car. This car. So what do? You go to a showroom, you go to a dealer, and you buy yourself a new car. Okay. So when you buy that new car from the dealer, it's brand new, or as it is called, 0 meter. It has not been used before at all. It's first hand. It's brand new. You have bought the car from the primary market. So this is the first categorization that we will use. Primary market. What is a primary market? Primary market is that market from where you can get first-hand goods, brand new goods. Okay. Now let's say I've bought that good, and I started using the car, and I use it for 1 year, 2 years, 3 years. And in 2025, I say, all right, enough. I have enjoyed the rides on this car, and now I want to sell this car and maybe buy a new one for whatever reason. I need money or whatever. I want to sell this car. I don't want this car anymore. I want to liquidate it. Liquidate. Liquidate means converting it into liquid cash. I want to sell it. Now, let's say I bought the car from the Honda company. Can I go back to the Honda company and say, I've used your car, please buy it back from me? Impossible. Impossible. Once the company has sold the car, it is never going to repurchase it. It's never going to buy the car back. Okay, they are busy making new cars. You bought the 2020 model. Now they are busy making the model for 2026. Why will they buy their old car, the used car? They are not in that business. So the car company will never buy the product back. But I still want money and I still want to sell the car. So what do? I look for someone outside, outside the showroom who wants to buy the car of that make, of that model. Okay. Someone wants, is there anyone who wants a 2020 model of Honda? Okay. The Honda company definitely doesn't want it back. Yes, I find someone. Okay. How do I find it? Maybe I go on wheels.com, or maybe I put an ad in the newspaper and somebody contacts me and says, yes, I am interested in that make. I'm interested in that model. How much are you going to sell it for? And I quote my price, and he accepts the price, and the exchange happens. So this exchange has not happened of a brand new commodity. This is not a brand new commodity. What is this? This is a second-hand commodity. This car is now second-hand. It has been used for some time, for 5 years. But there is still demand for that car. So that's why somebody has bought it from me. All right. So this market that has emerged is very different from the market where the cars are also being sold by the dealers. Brand new cars are also being sold. But cars are also being sold between consumers. Okay, there is, this market is called the secondary market. So there's a primary market where the car was sold brand new, and now there is a secondary market, or simply put, it can be called the market for second-hand cars. Okay, so now two markets have emerged. The first market is that market in which you sell cars which are brand new. That's the primary market. The second is where you sell cars that are second-hand. That's the secondary market. So every car can be sold in two types of markets, in the primary market or in the secondary market. Now let's talk about the stock exchange. The share of a company. Think about the share of the company as that car that was manufactured the first time. Okay. A stock exchange is a place where financial assets are bought and sold. Okay, yeah, now I've used the word place, but please forgive me for that. This is not a technical definition. I'll come back and refine the definition, but just in order to make it clear to you, a place where financial assets are bought and sold. Okay, some assets are real assets. They can be used, but financial assets are those assets which represent money. Simply speaking, they represent some financial value. So what is a share? A share is a certificate of ownership. A share is issued by the company, just as a car is made by the company and sent into the market. So the share, what is a share? Let's think about it a little bit. What is a share? Whenever a company needs money, it has some options to raise that finance, to raise that money. So it can sell debentures or bonds, and it can take a loan from the public and return it after 10 years. Or it can take a loan from the bank and it can return it after a few years. But shares is a form of finance in which you sell the security, you sell the share, the financial asset, the company raises the money, and the share has unlimited life. The share is not bought back by the company ever, except under some very rare circumstances. But basically, shares, once they are issued, they are issued. Okay, so look at it now from the investor's point of view. Now we are not going to use the word consumer. Look at it from the investor's point of view. There is a company that is selling shares to the general public. And there are some people in the public who have the money and they want to buy the shares Let's say Shell company wants some money. So it issues shares, it sells shares, and some people want to buy those shares. Why do people want to buy shares? For two things. Either over a period of time, they will get a cut of the profit based on how many shares they have, or the value of the share will go up. Okay, now this is where the share cannot compare with the car. The car, there are two investments that are very bad investments: cars and mobile phones or electronic equipment. Because these two assets, they do not go up in value over time. Over time, they only undergo depreciation, which means their value falls. But there are other assets that increase in value over time. Antiques may become expensive over time. Gold might become expensive over time. Land might become expensive over time. So now think of your share as land. What happens with land? The value of the land increases with time, usually, unless you are in a war zone. The same thing happens with shares. When people buy shares of a company, they invest $100,000, let's say. They will keep the shares, and over time, they will expect the value of the shares to increase. So what happens? You put 100,000 in the shares and you're doing nothing. You go to sleep one night, and tomorrow morning, the company posts a profit, the value of the share goes up. You suddenly become rich. You become richer. So in economics, we use the term shareholders' wealth has increased. This is shareholders' wealth. When he puts money into the shares, when he buys shares from the company, the Shell company has sold shares because they want money for their business, whatever they want to do. They want to put money in. They want to put money in financial assets, or they want to put money in real assets, or they want expansion, or they want money for their activities. But people who buy shares, they have just one objective: increasing their wealth, increasing shareholders' wealth. That's what they are interested in. So, coming back. Now, what happens? The company has issued the shares. It's not going to buy it back. It's like a car. We've made it, we've sold it. Okay? We're not going to buy it back. But after 5 years, the value of the share really goes up. From 100,000, it climbs to 1 million, let's say. Now those people who have those shares, they want to liquidate it, just as our friend who had the car wanted to liquidate the car. Now they want to liquidate the shares. Okay. So what do? Can they go back to the company and say, hey, I bought these shares from you. Now, can you please buy it back from me? That's not going to happen. That's not going to happen. So this person, what will he do? He will go to another market. He will find people who are interested in buying shares of Shell company from him. Okay. Are these new shares? Have these shares been issued first time? No, they were issued 5 years ago. Okay, they were issued 5 years ago. And because these shares are not new, we will now call them second hand, but we never call them second. So that word is used only for cars. We will say that these are shares that have not been issued first time, and they are being sold by existing investors to new investors. And the market where these shares are sold between investors is the secondary market for shares. So now shares also have, or financial assets, financial securities. I've just used the example of shares, but this is true for any financial asset. So like cars, financial assets or shares or bonds, they are also sold in two types of markets. The primary market for shares. What is the primary market for shares? When the shares are issued first time, or as they say, stock, shares of stock. When stock is issued first time, that's the primary market for shares. And by the way, where are the shares issued first time? If the Shell company wants to issue shares, new shares, Where will it sell the shares from? It's going to sell these shares through special banks called investment banks. So the investment banks are the primary market for financial securities or financial assets. And when I have used those shares for 5 years, I've kept those shares for 5 years, and now I want to resell them. Now I cannot go to the primary market. Now I'll go to the secondary market, and that secondary market for shares is called the stock exchange. All right. So let's revise the definition of the stock exchange. What is the stock exchange? Stock exchange is the secondary market for shares. Simply, it's the secondary market for shares, or it's the market where second-hand securities are exchanged between people. So, and there is a certain mechanism used in the stock exchange in order to buy and sell shares of a company. The company has to be listed on the stock exchange, and you have to go through certain players in the stock market who are called the stock brokers. Okay, they're called the stock brokers, and these stock brokers will then bring about, because they are the market insiders, so they will bring about the connection or the interaction between the buyers and sellers of shares. Some well-known stock exchanges or stock markets in the world, of course, the two top are New York Stock Exchange and the LSE, which is the London Stock Exchange. And then there's one more, NASDAQ. NASDAQ actually has usually has more market capitalization than the New York Stock Exchange. And there is a slight difference between the two, but these are the two. And then, of course, the Tokyo Stock Exchange and the Karachi Stock Exchange. So, so this is the this is a brief overview of what a stock exchange is. Please keep in mind, when trading in stock exchange, some risks are involved, and successful players in the stock market know how to diversify their risk. But that is a discussion for another lecture. I hope this was useful to you. Thank you very much indeed.